Good morning, everybody. It is April 19th, it's 2015, and this is the weekly review where we take a look at what happened last week, what the projections are for the coming ones, and of course, look at the portfolio. Today I'll spend a little bit more time on the portfolio as I got a lot of earnings about to hit, and we've got some breakdowns as a result of what happened on Friday. And what happened on Friday was a pretty good slapping again of this market as it reached up for the highs. Percent a quarter, pretty much across the board, pretty much flat on most of the or on the indexes. You know, the Dow Jones and the S&P, and then you're still up on the more volatile ones. You know, technically, fundamentally, what happened? Well, until Friday, they looked like they were going okay, and then all of a sudden they pulled the plug. Matter of fact, you know, if you remember, on Wednesday the Russell began to break out, and that was this breakout here, held the next day inside days, which don't tell us anything, on Thursday, and then of course we gapped down back into the range on Friday. So, you know, all the good work that had taken place totally taken away, and it's even worse than that when you think about it, because the Russell was the one that was trying to lead us up. So if I take and you know, do the retest regen bar, which was a small bar breakout. What did it do Friday? Well, it gapped right at the low of it on the retest and just proceeded to break it down. So when that happens, and in this case the Russell was the only one that had broken out, when that happens, that says, okay, you're no longer in the bullish breakout mode, you're back into some sort of a range. And if I had to guess where that range was, I'd probably draw it as this. So it looks to me like it's going to come back into this bar, back into this low, and build out the range again. And we have seen this over and over and over for, what is it, 5 months now? And every time they start to pull higher, they get pulled back in. And why is that? Well, because this market is not driving things. In other words, we don't have fundamentals here. We don't have the technical setup here to drive this market higher. In fact, the technical setup that we keep getting is for this market to break down each time it tries to do something. So for example, we had an ABCD structure here. That one actually got met. But if you take the larger one, which was trying to set up, and let me go grab it right here, this one had broken out, right? Projection was higher, had broken out, got over the gap, right? Everything looked positive, and then what does it do? Immediately fails. So I can't look at this market and say to myself, hey, you know, the projections to the top side are going to fulfill anymore. Matter of fact, I even said that last week. Every time, not every time, but almost every time we get any kind of decent structure to the upside in terms of some, you know, size, what happens? It fails. It fails over and over and over. As a matter of fact, I think this one itself had even failed, right? We didn't even get to this one, the one that was out there. So over and over, we keep seeing the same thing, and what does that do? That gives us less and less confidence on the upside. Looking, you know, elsewhere, you know, fundamentally, the earnings so far, they're really a wash. They're not throwing in the towel, so to speak. In other words, the companies. So you're not getting that wash out. They're hitting their lowered bar numbers, are coming very close to them, or maybe a little bit over them. But it's not a washout. And the Fed's the same way. The Fed keeps talking about it's going to raise interest rates, and then it keeps saying, well, maybe not. You know, not as soon as we thought. And you get a lot of anymore, you know, with the Fed speakers on the traveling circuit, right? You get so much noise out of the Fed anymore. You know, one says this, one says that. That it's really just a wash. You're not getting any kind of direction out of them. The biggest thing is this, and that is that Europe looks to move into more of a consolidation mode, while Hong Kong really doesn't have a tell yet. And I think we should focus on these for a few seconds, because these are the drivers in our market. So looking at Europe first, and I'll start with Germany. You know, Germany had been probably the strongest index inside um, the European market, biggest, strongest in terms of economically. Germany had done some good stuff on the way up, right? We had ABCD structures fulfilled back and forth on the way up. Then we had additional ones fulfill, right? And so this has been doing exactly the sort of thing you'd like to see of a market that's moving higher. And most recently, it was trying to set up another one on this retest regen, right, to potentially set up another ABCD structure. But instead, Friday, you get the breakdown. And so Germany, if we look at it, it no longer is in that expansion mode. In other words, that bullish drive higher, but failing on this bullish retest regen on the high, it has moved into some sort of a consolidation mode. And so when it does that, the first question always is, where's the consolidation? Is it going to be here? Well, volume was pushing pretty heavy on Friday. It's going to test, it looks like they're going to test this low, has more volume. So this is kind of a dangerous setup right now in that expansion could get larger, right? It could get much larger. Matter of fact, we don't even have a retest regen off this area. Well, actually we did. We had it the very next day. But we could expand all the way back down into here. So that's, just looking at Germany itself. Okay, so that one says no longer bullish, sideways at best for now. Now, if we look elsewhere, and we'll look at France next, it doesn't look quite as bad. In other words, here you actually have the breakout bar there, right? No retest regen. It's more than 6 bars, and you're coming back into it now. So France actually has the structure to support some sort of a retest regen higher, right? Which, if you think about Germany now, that potentially could get it back up towards the highs up here on the French market. Now, that if that happens, in other words, if that high probability bullish retest regen occurs, then we should see a decent bounce both here and in Germany. And that would be an opportunity when we think about our portfolio to reposition a little bit in Germany now that we've seen the bullish retest regen fail there. All in all, it says we're probably moving into some sort of consolidation mode in these indexes. So that consolidation, whether it be up here initially, maybe it's as broad as there, right? So you got a kind of equidistant one below it. Maybe it's going to set up this way and you get this big consolidation now for some number of weeks or months. That is Europe. If we look at Asia, Asia still hasn't, and I'll use the Hong Kong market, Asia still hasn't set up that pullback yet. It's struggling, when I look at it, and what I'm talking about in terms of a struggle is you have a high volume high here, you go over it there, but you actually stay over it, right? Then you kind of fade sideways, and you didn't quite test the top yet. So it was close, but it wasn't a test. That top was 28,031. You got to 27,969. So no test yet. But if this does test the top on lighter volume, go over, back under, then that will be an over-under because we've gone sideways for a while. And then that potentially will set up some sort of a consolidation here. Now, the reason I'm paying as much attention to these now is because if we look at the U.S. markets, they're totally dependent on these markets. In other words, we're not driven by our own economics or Fed anymore. We're driven by, the overseas markets, both Asia and Europe. And if this sets up a consolidation, and we've already seen Europe set up a consolidation, then the U.S. at best will do a consolidation, and probably because it's weaker, will actually do a larger one. So when I look at the overseas markets and the way Europe in particular traded this week, I'm somewhat pessimistic again in that we fell on the attempted breakout in the Russell. Europe fails on a bullish retest regen in Germany. That says it's going to be tough rowing again, probably near term. It doesn't mean we're going to crash or anything like that, but it says we're not going to just spin higher. So with this taking place, you have to, at least I have to, say to myself, okay, it's a good thing we don't have much of a footprint. And matter of fact, we probably want to keep a small footprint and maybe even explore the short side, which I'll talk about here in a little bit. What's the positive? The M&A continues. We have to start thinking about some of the deals potentially failing now. What happens if some of these deals that are already on the table, already announced, and I'm thinking about Comcast in particular. Comcast is supposed to close on Time Warner, still hasn't been approved by the feds. If that falls through, you may see a ripple elsewhere, and if this starts happening, M&A starts falling, that's been a big driver. I mean, it's been one of the reasons people have been able to stay bullish, because you keep seeing stocks get big boost, price-wise as a result of these various M&A deals. And it also, most people view M&A as constructive. If a company is buying some other company, they see value. Well, maybe they see value, maybe they see it as kind of a desperation act, and I believe that's what we see mostly now, a desperation act to take on some sort of, because they can't do organic growth, they go out and try to get the growth from somewhere else. And I think that's a lot of what we're seeing right now with this M&A. So if we start seeing these fail, that to me is a bad thing and would be hard. Another positive, the dollar looks range bound now. Let's take a look at it. So remember, if we look at the dollar on a longer term basis, huge run up. Then you come off, and you came off with volume. This big volume bar is a bar down. So you have a nice big spike up, big volume bar. That typically is how you get some sort of a consolidation start to take place. The question was, and we talked about it before, is would that consolidation be limited to there, or would it actually get a farther consolidation? And I'm starting to think that, given what we just saw in Europe, that potentially this range may expand. In other words, this area may get broken and we may move into the lower consolidation, and that would be a quote-unquote positive for the general markets, because so much of what's being blamed as wrong right now is being blamed on the dollar in these earnings calls, and I'm sure we're going to hear that over call after call after call. So if people wake up and say, oh, the dollar is trading lower, then things are going to get better, then they may make that, that leap of faith that things will get better. I don't know that we're going to go into the lower range, but it does look like we're going to try to come back and retest regen off these highs. As a matter of fact, that would be the first time to come back into this area, and the area I'm talking about is here. And if we do that, then I would think that more than likely we'll get some sort of sideways to higher action off of it. That's typically, what happens in that technical setup. The probabilities are very high that you're going to get a good bounce. We're talking 90th percentile. So especially if it comes straight down, right? Because if you get a press down into that area and it holds, or it hasn't tested before, probabilities are very high that that thing is going to bounce out of there. So that's the dollar. If I look at the other side of that, Europe in particular, the euro looks like it wants to come back into this resistance zone, maybe test up into there. You got a big bar here. It's going to bounce up into there. Nothing special, just bouncing, just consolidating after another big, long decline, right? You get these huge declines, then you get consolidation, and that's what this looks like. If we look at the yen, it's the same sort of thing, right? The yen is actually just getting over the swing point highs. It's the first time it's done that in a while. It looks like it's going to test back into this area. These bars were the last time bars that we had volume on. So what is that, 82 up to about 80, looks like about 82, almost to 83. So yen looks like it wants to travel higher, and you look at it, what is it? Just a consolidation after a huge spike down again. And so these all look to be in consolidation, and that being range bound is probably a positive for our domestic markets, just given the mindset. The negatives, the upside failures, they happen or have happened with increasing frequency the last 5 months. And so it's hard to have any confidence that any of those projections are going to work anymore. And that's a real problem. We haven't seen that in 3+ years. And that is, it's a warning sign that things are not the same. And I've been saying that for a while. It's hard to get ourselves in that mindset And believe me, it's hard for me to do the same thing, but that's, we have to keep telling ourselves it's a different market. And it really is a different market. These stagnating prices, and I talked about this last week, I didn't spend a lot of time, and I want to spend a little bit of time looking at it right now with you. They give the potential for a much larger breakdown. And so I flip back over to the S&P 500, and what I'm talking about is the formation of a lot of swing point lows located fairly close and not that far away from current price. These swing point lows, if broken, right, can lead to a faster move to the downside, especially if we kind of, like, let's say this week, if we gyrate down into this area and just kind of hang down here for another 3 or 4 bars, gather up maybe an ABCD structure kind of situation to take us down and break these things. That's a dangerous situation. And if you look at it on the S&P, if you look at it, and that price point, that low is 2039, this one is 2045. Now if I go to the weekly, 2039 is up here, right? That's this one. So you'd only have it on that time frame, but if you get some sort of a consolidation break, you have the potential to come down here and start looking at the next set of lows. And there will be daily and weekly lows down here. If those break, they would be extremely dangerous because you would have multiple swing points on multiple time frames now potentially breaking, which could drive you all the way down here, which will print on the monthly as well as a swing point low. And you can see kind of the cascade type declines that could develop as a result. Now we're a long way away from that, and I don't want to get too focused on that yet, but you always have to look forward and say, are we building out that structure, right? Because the structure is important. Are we building out the structure, right, to get multiple breaks, multiple time frames? Here, no. Here, yes. Here, of course, yes. And here, it's on the long term and the intermediate term. And that, folks, that's where the real danger comes in. So we're ways away from it. It's something to keep on our radar screen. And if it's going to happen, it's going to take a while. But that structure, as it builds out, becomes more and more dangerous if this market can't move higher. How do you solve it? How do you get rid of this risk, right? These risks? Well, you go higher. And right now we can't do it. And if we can't do it and we don't do it, then we're going to have a bigger issue on our hand. Another thing I've pointed out before is that these ranges, right, have gotten smaller and tighter as we've gone up, both in terms of their duration and in terms of their size. And so, the duration here, a lot longer than there and a lot longer than here, at least so far. And certainly the width of these much different as well. Again, that's kind of what happens. And a lot of people show it in different ways. One way people can look at it or like to look at it is some sort of a rounding top, where you round over. And maybe that's what's happening. All I know is that I'm building out the structure that's more dangerous, and I have to pay attention to it. All right, let's move on here. I don't want to get too much more right. I think I focused on it. The top side projection fails. The Russell I've already talked about. The central bankers are still aggressive, pretty much in Europe and in Asia. So that is a big positive. And folks, the thing is that if you look back at the history of QE, and we don't have a lot of history to look at, but every time it's introduced, you get big pushes in equity markets off of it. You get consolidation off those push, and then you get more of a push, right, as they continue to dole out the money. I expect this one's going to be the same. And it's one of the reasons I don't want to get hung up on some sort of big bearish view right now, because it's probably going to take a while to play out, because you got QE flowing like crazy now in Europe, and it's going to continue. And Draghi reinforced that again this week. And you've got the same thing happening in Japan, in Great Britain. In Great Britain and the United States, they continue to do QE, even though now it's just refunding QE. And then you have China with, even though it's not QE, it's huge lax policy initiatives to drive, spur growth there, and then all these initiatives to boost their equity prices. Now, the thing that supposedly set off Friday's sell-off was, an attempt by Chinese authorities to reel in the market a little bit because it's gotten so wild to the upside. That's what they do in the commodity markets here. That's what they do in general places, is you institute some rules to slow things down. And that doesn't mean they're going to stop. It just means it's going to slow down a little bit, and that may be potentially going to set up some sort of a top consolidation there, but we'll have to see if it plays out that way. Fundamentals, economics, earnings, right? Those are probably the negatives. What do I watch for this week? I want to see if those indexes and sectors come back in to the breakdown bars lows. Do they go to the lows? And so if I pop back over, and let me grab the chart again, and if I could pop back over, we're back into this breakdown bar. And we've seen these before, right? So for example, let's go back to the last one that happened. You get up here, you consolidate, and you get a breakdown bar. What do? You get over it here, and then next thing you know, you're back into the bar here, and not only that, you'll seek the bottom. Well, now we have the same thing again, right? Our breakdown bars were here. What do? You come all the way back up to test the top, and then what do? Next thing you know, you're back inside the breakdown bar. That means, is it going to go seek the bottom? Odds are high it will go seek the bottom. And so that is what we're looking at. That says that we're probably going to see some sort of push to try to get into these lows again. And then it will be a question of, do you start breaking the lows or not? And that low is 2061. We closed at 2081, so we're about 20 points away, not that far. If you look at it on any of these indexes, they all look the same. Let's just go to the NDX, which has been the weakest one. NDX, same thing. Breakdown bar over here, you get over it. Breakdown bar, back into it, you seek the bottom. Matter of fact, you had two here, it went all the way and tested the low one. Now you come back up, you test this one, tried to test to get over it, couldn't, and you're back into it and you're seeking the bottom, and it almost got there. 40, and this is because it's the weakest, 43.29.29, we got to 43.33. This will more than likely hit that bottom to start the week. And we were just talking about those swing point lows. Look at them on the NDX. They're all lined up right together. Right? Those lows are lined up right together. You got another one up underneath here. A break of this area, and this has been the weakest. On the upside, you want to watch the strongest. So what we were watching was Russell, right, on the breakout to the upside. Well, the NASDAQ is the weakest right now. So this is the one I would be watching on the downside. If you start breaking these, you can get the cascade down. So this is probably the key index to be watching. Can it get into those lows, and what does it do when it gets there? And then on the other side is the range breakouts. Are they going to, is that formation going to, are we going to see breakouts of the ranges, right? And this is probably the easiest one to look at. You had the range before, right? One up underneath it. Is it going to hold this range, or are we going to force ourselves into the lower range? That's the question, and that's what you have to watch. This is the index to be watching. Okay, let's pop on in here. Economics. Fed meeting next week, not this coming, but the one after. So the Fed speakers are on hold again. So finally they stopped and shut up for a little while. There's nothing really that stands out here. There's a few things. You got some PMIs, but outside of that, not a lot happening. What's the bottom line? Last week I was on the fence. We got that break on Wednesday with the Russell, suggesting that we were going to see some follow through from the rest of the indexes. I increased my footprint a little bit on Thursday as a result. And then Friday, they dump on us. And so this push for higher highs, of course, failed. We didn't get it. And, here we are looking at a range again, and potentially some more selling this week as a result of it. The most important thing that we have to keep forcing ourselves to remember is that we're not driven domestically right now. We're driven overseas. And those are the markets we have to keep watching, because they're the ones that are giving us the direction. And so I'll focus on that more, and you should too. Portfolio, let's look at these. I want to spend a little bit more time here. So the two that we made the footprint a little bit larger on was AYI and CarMax. Both of these post-earnings plays, all I was doing was looking for things that were strong that could give us some added exposure and not a lot of risk. AYI is one of them. Earnings was here. A nice big spike, high and low. That says that there's some sort of a range here. It's probably going to play out for a while. That range is there. We want to try to sell towards the high of the range, buy towards the bottom of the range. So I'll watch it as it comes into here. I'll watch the rest of the indexes, world and domestic, to see what they're doing. If it looks like they're going to continue a range and reversing, try to come back up, this is one to try to buy as it comes into those lows. The next one is CarMax. Now CarMax is a little different story, a lot more volatile, and that one, even though it was the idea here, and if you remember, we took a smaller position in this one because we didn't know if it would hold this low or actually try to fill this gap. Well, it's trying to fill the gap, and this one, the real story is over here on the weekly, and that is that you have this huge support zone, this little area here. So that's the area that as it comes back into, that again is the place to buy. The stops are down here. The target is back up there. So, this one I like it, but again, most boats rise when the tide is lifting, and most fall when it's going out. And right now, this market at best is a fast tide in and out. And so we have to realize that, individual setups, even though good, and even though they probably won't kill us, they're not going to reward us unless the general market allows it. And so, here, the buy is here. We'll have to see what the general market's doing when we get into that area. The rest of these, that are trades, they're coming back in, like Facebook, test the low. Facebook actually fails finally on the retest regen here. So we don't hold that retest, bullish retest regen. Earnings this week, that will be the story here. It did hold so far on this weekly, so it's not all is lost. That low on the weekly is 80 bucks. And so we've got, we've got everything riding basically on earnings. And how that plays out will determine whether or not this thing holds up or not. My stops are not that far below. If it can't hold the bullish retest on the weekly, then we just have to abandon the position for now. If we look at the other one that's still out there, they report earnings as well, and that's KeyBank. So the earnings came out here. This one actually the earnings looked not that good. They missed slightly on revs, but they actually bottomed. And here again, just like we've seen elsewhere, you've got a big bar again. So you got a wide price spread bar. You got volume on it. That says that it can test the low again. It can test the high again. I liked the way it traded. Had the general market traded well on Friday, this thing probably would have reached up here to test these highs, but it didn't. And so it's an inside day. We're going to potentially test the low or potentially test the high. And either way, I suspect, this was a good looking chart, but this is just another classic set of failures. On the weekly, gets over the swing point highs, should try to carry. It was multiple breaks, multiple time frames. It doesn't. Again, just a warning sign that all these trades simply aren't doing what they typically do, and that's because of a reflection in the general markets not doing so well. So KeyBank will probably try to sell it out on any kind of a push back up towards the highs, and we got stops underneath. And you have to have stops on this because you got lows all lined up together here. This is not something you want to stay in if it starts breaking all these lows. HEWG, now this one is kind of a classic study because we were trying to ride the coattails of Germany. And I'd taken a fairly large position in this myself and in the portfolio. It doesn't hold. I've already gone over it, so I'm not going to go over it again. But it's down here to test this swing point low now on the German index. And if we look at the hedged currency position, it's already broken 2 of 3 swing point lows. Potentially can come all the way back now and test lower. So in other words, we have a range trade here, and then a range trade up underneath it that takes us back into the support zone. If it can't hold, if the German market can't hold that swing point low that is going to test this week early, it looks like, this potentially can come all the way back. And so even though I have a large position, you know, my ideal was to stop out down here somewhere, not, you know, to give it a lot of room, because I think, just as I said at the top of the show, I think that over time this is going to consolidate and then eventually go higher again. So for now, it's moved into that consolidation mode. It's a question of how much it's going to consolidate. If we're fortunate and the French market does what it wants to do, then we should get a bounce back up into this area. We can reposition a little bit with the ideal of potentially buying lower on that longer term core position that we're looking at. If it doesn't do that, you know, and it starts, you know, into this area and the French market fails, you know, then we definitely don't want to buy anymore until we get down into this area, you know, for a long-term core position. We'll just have to hold on to it until it does it. And that was the plan going in. You know, it was a core position. We had much wider stops, and that's the way we traded. So, you know, it didn't work out the way I wanted, so we'll just have to work around it. Looking at the others real quick, I'm not going to go into each of these. They all have earnings. eBay not as strong, and so this one I'm not as interested in. Again, like the others, it failed. It failed to do what it should do. So we've got a failure here. That failure was on a breakout, retest, regen immediately. Shouldn't do that. It was a breakout over multiple swing points, multiple time frames. Didn't do it, and what do? Well, we come right back as a result of it. Docs, now this one actually looks really good. They have earnings coming out too. The volume flows are great. Everything about this stock looks good. Let's see what the earnings are. Maybe we can add to it again post earnings. Same thing with NXPI. This one still looks really good. Let me go find the stock. It still looks good. And again, if it comes down into these lows and it looks like it's going to hold, that would be the place to buy it again. Now this also, you know, if you remember, this jumped up on one of those deals. So if the deals start to unravel, this one could get hurt. But right now still looks fine. And Celtic is the other one I've had for quite a while. Earnings didn't do very well. Spikes down, right? But if you look at it on a weekly, it was just a test of these breakout areas. So right now I still like the way this one looks. They've got earnings slated on the 27th. I'm not sure why we're getting earnings now. I thought they would be later. I need to look into that a little bit more and understand it, because we just had it back here on March. So maybe that was, I don't know what that was. I'll have to go back and look, because the earnings are showing on the 27th. I've got to go to the company site and see what they're doing. What you will see in the portfolio spreadsheet is I've pretty much taken off all of the position adds and sells into earnings. There's no reason to have those, you know, sell it or buy it into earnings. Let them do the post earnings, and then we decide what to do afterwards. Okay, so that's a pretty good wrap of everything. You know, I'm disappointed and frustrated with this market, probably just as you are. You know, it's easy when the market's going up, you just throw your money out there, everything gets bailed out. When it's not that way, you have to think about it differently. And one of the things I think we have to think about differently is, do we want to short this market at some point? And thinking about that, you know, where would the short be? It would be here on the NDX. That's the weakest sector, index. The difficulty in that, of course, is that all the earnings are coming out. And so you certainly don't want to, you know, or at least I don't want to short an individual stock. Where would I short this? Well, you know, let's just say that we go sideways this week, and most of the earnings are going to start coming out this week and next in this sector or in this index. You know, this area here, you'd want to try to short somewhere up towards the top, and the reason for that is you don't have a lot of risk up over it. You'd have to have your stops up here somewhere. So you want to get as high as you can. Where's the reward? Well, you know that it may hold here or potentially break, and if it does break, then you've got this zone way down here. So I will look at this hard this week. I'll look forward at the earnings, see which ones are reporting, how those individual stocks look, and potentially put on some sort of a short trade on the Qs as kind of a counterbalance to that HEWG, which is our largest position holding right now, and kind of cushion it if in fact we do get some sort of a spill. But my inclination right now is that short, really, you want to put it on a little bit later, maybe not quite yet, and so I'll probably be hesitant with that idea, even though it is finally a consideration at this point. All right, folks, hopefully that's a good wrap. Thanks for being there. If there's anything I can do to help you, just give me a holler. I do value your membership and want to help you any way I can, so let me know if there's something I can do. Have a great one. Thanks. Take care. Goodbye.